Welcome to the Lend Academy podcast, episode number 96. This is your host, Peter Renton, founder of Lend Academy. I am here in the Zopa offices in London with Jaidev Janardana, who is the CEO of Zopa, a position he has held for the past 18 months or so. Now, most listeners will know about Zopa. They're the first peer-to-peer lending platform in the world. They started in 2005. They've done over £2 billion in loans. But despite their age, I mean, they're hard to call them a startup after 12 years, but they are not afraid to go in new directions. They recently decided they would pursue a banking license. We're going to go into that in some depth in this interview. We're also going to talk about their core consumer lending business, the different product mixes they have, and what else is new. So with that, welcome to the podcast, Jaidev.
Thank you.
So let's just get started by just giving the listeners a little bit of background about yourself, what you did before you came to Zopa.
So I joined Zopa in 2014, then as Chief Operating Officer. Before that, I spent 12 years at Capital One, both in the US and the UK. Actually, started my career in the US before moving to the UK in 2008. And I did various roles in marketing, product development, credit, and operations. The most significant of them that I remember is kind of actually managing credit risk for the UK business through the recession.
That would have been
2008, yes, which was a fantastic learning opportunity, and I think prepared, I believe, a lot of us well, those who were managing credit well for kind of managing credit risk through the cycle, if you will. And once things got better, I took a broader role doing marketing, product and credit for the UK business, and really helped business come back to growth and profitability. Mm-hmm. And once we kind of done that, I found Zopa and I joined.
So what was behind the decision to come to Zopa then?
So for me, when I met people at Zopa, the first thing that came out very clearly was that the heart of the people was at the right place. And by that, what I mean is that it was easily by far the most customer-centric financial services company, in fact, probably the most customer-centric company I'd ever met, which really stood out in terms of how much people, Giles, the board, and some of the management team cared about doing the right thing by the customer. And I fundamentally believe that that's what's broken about financial services, that there aren't enough firms who have that customer centricity engraved into their DNA, as Zopa has. And that actually plays through then in a lot of the performance that Zopa had and through its kind of history as well. So I think Zopa's track record in terms of managing credit risk is unparalleled. It's difficult to find a peer for Zopa in terms of how it has managed credit risk and consistently delivered positive returns for its investors. And that prudence in risk management actually showed both the fact that the management and the board understood that growing and building a financial services business is as much about taking risk as much as about being prudent about how you take that risk. Mm-hmm. And that gave me a lot of confidence that the people here are in here to actually build something long-lasting and something that's enduring. And that's what I was looking to do. So
Right. So now you've been here, as you said, for about 2.5 years. And, you obviously spent a long time at Capital One, which, while not a 100-plus-year-old bank, is certainly a more traditional financial institution than Zopa. So what would you say are the similarities and differences culturally between Zopa and Capital One?
I think that's a very interesting question, and it's also a hard one to answer some ways because of the very different almost maturity or evolution curve that these two businesses have. So Capital One has been around now for 20 plus years, but more importantly has about 30,000 people, £3 billion in profits. So it's at a different stage. It has made a huge mark in the world. Whereas Zopa, I believe, can make a bigger mark, but is not there yet. So in that sense, the comparison is hard. But if I had to still go ahead and make it, I would say that the similarities come from some of the values and how we manage a business. So I talked a little bit about prudence and risk management. I think that's something that I learned a lot in Capital One, and that's why when I saw the same at Zopa, it kind of struck a chord for me. The second is actually really relying on data to make decisions and investing not just in kind of building that and collecting that data, but actually having the right talent to be able to use that data and create insight. And if I could take that further, I think there is a common belief, I think, at Zopa and Capital One that at the end of the day, the only source of a competitive advantage is in our talent. And there's that commitment to really find the best talent and letting them do great things once they are in. So those I would think would be the key commonalities that I can see in the cultures. The fact that Zopa is a smaller and a more agile and a more nimble company, I think enables us to do things differently than some of the bigger organizations, including Capital One. I think the place where I feel we do a tremendous job is in the way we can put together people from various disciplines. So data scientists, analysts, marketeers, compliance specialists, and having them all work together in what we call tribes, cross-functional teams, is something that where we've taken that idea of cross-functionality to the next level, where all these people actually really report into the same person. So a lot of people talk about cross-functional teams, but retain their individual reporting lines, versus what we have done is have them work together, which I think has enabled us to deliver things at speed, but also in a fairly controlled fashion, which I think stands out for us in terms of the extent of cross-functional collaboration we are able to create. And that I think is today easier when we are the size we are, and it's something we're very keen to retain as we continue to grow.
Right, that will be a challenge, I'm sure, if you get to the size of Capital One. Anyway, I want to spend a bit of time on the announcement you made a few months ago now, your decision to pursue a banking license. So I've got several questions here, but the first question I want to pose to you, because there's certainly been some negative press, there's been some positive press around this decision. So I'm curious to know, like inside the company or from your perspective, how do you think it's changed the brand, the Zopa brand, since you made the announcement?
So I think I'll take the answers in terms of how consumers perceive us, as well as how internally we feel about the company.
Right.
So how consumers perceive us, I think I haven't seen any difference. I think the level of trust, the level of advocacy continues to remain. And in fact, we received a lot of both positive feedback and anticipation from our customers saying, when would it be? And we would love to kind of use some of the additional products that would come out. In fact, one of the reasons that we went down the path before we made the decision was actually to talk to our consumers and see if they would have the demand for the other products that we could launch as a part of a bank. And when we heard resounding positive feedback, it really helped us make that decision. So from a customer standpoint, I don't see there has been any difference. I think internally the decision has been incredibly well received, and there's, I think, created a ton of excitement and energy. Because if you go back to why we did this, I think our main motivation was to be able to serve our customers in a more broader fashion, more of their needs. We were doing effectively, loans, and we wanted to kind of meet more flexible needs of credit in offline spaces, and so on and so forth. And we felt that was best delivered through a balance sheet model funded by bank. And thus, us taking that step has effectively unleashed, if you will, a ton of creativity in terms of how we can apply our skills in different places and meet different needs of the consumers. And that's been incredibly exciting for the employees.
Right, because you really have a blank slate. You can create this organization any way you want, within regulatory guidelines, of course.
Yes.
Okay, so I'm curious because I had Mike Cagney, the CEO of SoFi, on a couple of months ago, and we talked a little bit about that, because they're obviously also pursuing the bank path. I'm curious to know, is the fact that what SoFi want is for their customers to really use SoFi for all their financial needs.
Yeah.
And you can't do that without some kind of deposit-taking facility, and they have to get their payroll deposited somewhere.
Yeah.
And I think what SoFi would argue is that they want everything to be inside SoFi. Is that the same thinking, or is deposit taking the real attraction here? I'm just trying to get at, you've talked about other lending products, sure, but do you want your customers to be 100% Zopa centric when it comes to financial services?
No, I don't think so. In fact, I feel that where regulation is going and where technology is going and where consumer preference is going, I think the customers, they definitely do believe that customers do want almost a trusted provider to help them find the right choices. But the trusted provider doesn't have to actually provide all the products. Right. So if you look at what is happening what is expected to happen in Europe and the UK in 2018 around forcing banks to open up their data through open APIs and so on, I do feel that some of the fundamental, highly complicated banking products will tend to become utilities. So and current accounts for me is one of them, right? So today, customers hate switching current accounts because it's a hard thing for them to switch, and banks don't necessarily make it easy either, right? But in a world where you could access your current account through anybody else's interface, and and thus people who make better interfaces and can make and will guide you better can actually talk to the bank. The customers might not care whether they have a HSBC current account or a NatWest current account, because they will be talking to someone whom they trust to actually operate the current account on their behalf. Analogy I think of is of MasterCard and Visa. I mean, I really don't care if I'm carrying a MasterCard or a Visa.
Right.
They do something very complicated. They do it very well, right? But I am really talking to the issuer, right?
Right.
And I see the same thing happening with stuff like current accounts, where there will be complicated infrastructure which always works, which will be slower to change, which will be provided by a series of players, but then they will be looked upon as utilities and probably regulated as utilities. And you would have trusted providers, providers who have the trust of customers, who are providing an integrated view of financial services for the customer and doing the hard work by actually capturing all the API information and presenting to the customer. That's far more easily understandable. I think that's where we want to go.
Right.
There are some products, and when we look at our skills, what we think we do very well is unsecured consumer lending.
Right.
So we think we can provide great products in that space. And so we want to do that. We also think that for some of that, particularly revolving credit, the best way to fund that is through deposits.
Right.
So we do want to do term deposits. So not current accounts, but term deposits. But beyond that, we want to be able to continue to leverage the great trust that we built with our customers and actually be the best place for money for them.
Right, so you could see a time where someone would log into their Zopa account like they do today, but they can, instead of just seeing their Zopa investments, they could see their check account that might be at HSBC, it might be Santander or wherever, but it's all going to be sort of available through the Zopa interface.
Yes, and that's what the regulatory changes around PSD2 and open banking will enable it. And I think going back to the point you raised, I think, it's incredibly exciting for me, which is that we are creating this business from scratch, right? In some ways, we have a peer-to-peer business, but the entire banking products will be on scratch. And I think that gives us the opportunity to create businesses and pricing strategies where we consistently have a win-win attitude with our customers, where we win when the customers win.
Right.
And that is hard for the banks today to do. For example, if you look at the credit card market today, most of the new origination is done through incredibly long 0% teasers.
Right.
The length of that today is, I think, 42 or 43 months. Every time I say it, somebody says it has gone another month longer, right? That's 3.5 years, right?
Right.
And so the only way issuers are hoping to make money is that people forget to switch or cannot switch after that.
Right.
Right. When you have a business like that, it's very hard for when you are presenting the integrated view to the consumer to say, hey, by the way, your 0% is expiring. This might be a chance for you to consolidate, right? Because your business model is not geared towards that.
Yeah, so so the interests are not aligned. Yes,
exactly. As we are designing products, we want to make sure that we do not have products that put us at odds with our customer, right? And thus, we are able to actually present to them what is best for them, and we will win through that, right? And that's why we think we will have a good chance of being that trusted provider and being the best place for money for consumers.
Right. Okay. So then are you initially going to be focused on cross-selling this obviously to your Zopa investors and borrowers even for that matter, depending on what their needs are, or is this really going to be focused on bringing new people into the Zopa brand?
So I think, where we are, we have a customer base of about 300,000 customers that have used Zopa, which is a good base, but I think when you look at 60 million or 45 million adults in the UK, there's a lot more to go, right? So I want to continue growing by focusing on the same type of customers, but there are a lot more to be had. So I think a major part of growth will have to be new customers, just given the numbers we have. That said, we also think that because we have this customer base, particularly for certain types of products, our customer base would provide a valuable almost first route of mark to market. And the places where I think they will be very useful would be, if I think of deposits.
Right.
When we talk to our lenders, we've got about 60,000 lenders. A lot of the lenders have said that they think of their money in two different pots. One is savings, which is really they want FSCS guaranteed, same as FDIC guaranteed deposits. And the other is investments, which is what we get. Right. So the savings pot typically tends to be much greater than the investment pot. And I think we will get a lot of our early depositors would be our lenders,
Right.
Because they kind of say that, okay, I can put some money on the other part. Similarly, if I think of credit cards, I think is another place where I think a lot of our initial customers will be our existing loan takers.
Right.
If I think of my other products, be that personal loans or auto finance, point of sale finance, there we will continue to want to grow and add new customers, because that's where I think our market share is still small, and there's just a lot of headroom for us to grow there.
Right.
So that's the way we can think about it.
So just a couple more questions on the bank. Are you planning on having this be obviously it's a separate entity,
yes,
but is it going to be physically separate? Are they going to be here in the Zopa office? Is there going to be a Zopa bank office that is in the city somewhere? Or
no.
what are you?
I think no. So we will have the same offices. It'll be two different entities. We'll have the same offices. The plan is that the bank will be the more regulated entity, and thus as permitted by regulation and making sure that there is no conflict of interest, the bank should do most of the activities, right? And that allows the regulator and the customers the more comfort that most of what is happening within the regulated entity. We do not want to create regulatory arbitrage.
Sure.
And that's not why we are launching the bank.
Right.
So, and the other thing that's very important is that, as I kind of said before, the thing that attracted me to Zopa and where I think is one of its strongest advantage is the culture. And thus, we want to make sure that the same culture permeates both entities, and that can be best done by having us all together, so that we will be together. We will, of course, want to make sure that both entities' interests are well taken care of. That would mean having two different boards. That would mean having kind of risk management, compliance, actually probably duplicated on either side, and to make sure that neither the peer-to-peer investor or borrower nor the bank depositor or borrower is advantaged or disadvantaged, and all are treated fairly. So we'll have some duplication of those functions, but the intent would be to keep it all together, have the same culture, and have actually people move across from one entity to the other.
Right. So we talked about SoFi earlier, and I'm just curious to hear what your perspective on just the reality of the significant peer-to-peer lending platform. Zopa obviously has quite a decent scale when it comes to your competitors today. So I want to just get your sense on whether you think that other companies in the space, in the peer-to-peer lending space, are going to move in the same direction as you. I feel like we obviously have SoFi in the US, and I'm wondering if you think, obviously you're at scale and you can't do this really as you're a startup, or it's a lot more difficult, put it that way.
Yeah.
But do you think this is a way that other companies that are your peers will inevitably go this same route?
Yeah. That's a conversation I often have with Samir, who's a dear friend, and where we clearly have opposing views on this.
He has strong views on this.
Yeah. So when I look at what's happening in the US, I feel that a lot of platforms are beginning in one way or the other, putting more skin in the game, either through risk retention or having lenders who have significant equity and so on. So there is some migration from being kind of pure platform to more hybrid models, if you will. And there are different natures of hybrid models that people have taken. For us, and I think this is also something that we have in common with SoFi, is that we want to create a less volatile, low risk, and thus necessarily relatively lower return portfolio. And when we look at how to fund that, I think we've done a great job of finding investors, both retail and institutional, where we've been able to convince them about the low risk nature of our offering, and thus them accepting a relatively lower return. We've been able to do that even with securitization, where our first securitization that was done by P2PGI of Zopa loans, where we talked to the rating agencies. We got great ratings, and today, if you look at the spreads on the senior tranche, they kind of LIBOR plus 110, 120. So again, it talks about the lower risk nature of our offering. Now, when we thought about doing things like credit cards, which are not easily funded from a peer-to-peer model, we've always believed in wanting to find the stickiest source of capital. Right? That's reflected in our peer-to-peer business, where a lot of it is funded through individual investors, whom we believe are more sticky than institutional investors. And even the institutional investors we are either banks or funds with very narrow mandates, like P2PGI. They can only do peer-to-peer. And thus we think are more sticky than hedge funds with wider mandates. Right? And when we thought about, if I'm going to do credit cards, what's the stickiest source of funding? You can naturally come to the answer, deposit funded. And that's why, for us, it was maybe a more obvious thing to do than probably for other platforms. But I do feel that more platforms, not all, but more platforms will end up with some version of retaining risk on their balance sheet.
Right. So I just want to switch gears a little bit and talk about your core consumer lending business. So I'd like to, if you give us an update on that. I mean, it sounds like you've had like an oversupply of investors. You had a waiting list. You have a waiting list now. You shut down, I think, for a little bit to new investors. Give us an update on that business.
So in terms of the new loans we are doing and borrowers we are attracting, I think we are continuing to grow, having very healthy growth rates on that side. So just to give you some numbers, last year we did about 700 million pounds of loans. In the first quarter of this year, we'll almost do 250 million. So that is a run rate of just about £1 billion. So that business is continuing to grow at a very steady growth rate, which we like. What has also happened on the other side is, particularly post-Brexit, Bank of England reduced rates, and that created a far higher demand for assets than before. So just to again give you some numbers, the amount of new retail money coming into our platform, if I compare last January to this January, is more than double.
Wow!
Right. And I think some of it is driven by, of course, lower rates from Bank of England, which thus meant that a lot of banks actually reduced rates on their propositions. But some of it is also driven by the fact that we've continued to maintain our track record of delivering consistent return, as well as innovating on the product side for our retail lenders and innovating on the experience. But all that has meant that that side of the business has grown far more rapidly today than the.
Makes sense.
And I think, I'd rather be in that position.
Believe me, I think a lot of US platforms would die to be in that position as well.
And I think, as a company, we have had a philosophy that we want to treat our existing customers well first, before wanting to add new customers. And I think that's not a philosophy you often see in financial services, but we take pride in that, the fact that our existing customers should get a stronger preference. So as we looked at the volume, we felt that where we are, we can continue serving our existing customers well, provided we don't take new money into the platform. And we don't want to take new money and have it wait for a long time either, which is what we would have had to do for our new rates. So that's why they've put a waiting list on. We do hope that on the borrower side will continue to grow. There are multiple initiatives that we have in the pipeline that will land over Q2 and Q3. And when that happens, we'll be able to lift the waiting list.
Okay. Well, I know we're almost out of time, but I've got a couple more questions I'm curious about. Like your Plus product, I just saw across a year. Yeah. That's obviously a higher risk product. Do you think that, obviously it's been successful for you guys. Do you think that means that your typical investor now has a higher risk appetite than, say, a year or two ago? Or what do you sort of think is the driving force behind the popularity of the Plus product?
So I think we've always had demand from our investors for kind of having more choice in terms of being able to take more risk for more return, or being able to take less risk for less return. So if you look at our product suite, we've got Access, which is the lowest risk, and we've got Plus, which is the highest risk, and there's a range of return. And I think that choice was something that our investors always wanted. Now, there was one thing that which was effectively UK tax law that made products like Plus harder to do before. And this was, the intricacy was the basic thing that if you're a retail lender, you could not offset your bad debts for tax purposes. What that meant is that you paid tax on your gross interest and then deducted your bad debts. So imagine a 10% product with 4% losses, thus you make 6%. You actually pay tax on 10 and not on 6.
Right.
That actually changed. That law changed. The Chancellor changed it mainly for us, as in not by us. By us, I mean all the peer-to-peer platforms. And if you actually lend through a platform, now you could. And that changed in April of 2016, which is what allowed us to introduce the Plus product.
Right.
Because what we didn't want to do is actually put a higher risk product in the Safeguard construct. This was why we had created Safeguard, because Safeguard was a way to almost take the losses before I gave you interest, and effectively solve the tax problem. So as soon as Safeguard went away, we introduced the product. As soon as the tax law went away, we introduced the Plus product. And I don't think there's been a change in risk appetite. No.
Okay. So last question, I have to ask you about this. Your chairman, Giles Andrews, has been in the news a lot lately with the decision to become, he's also going to be chairman of Market Invoice now. So What does this mean? There's going to be more collaboration between Zopa and Market Invoice? You're getting into invoice financing? Are you? What should we read into this?
Yeah, in fact, quite the opposite. So I think, and I'll come to why Giles, why Market Invoice and Giles found each other in a second. But I think the reason Zopa, the board, we all got comfortable with the decision was the fact that we thought there was no overlap between the businesses at all.
Right. Okay.
So thus there was no possibility of conflict, and thus Giles, who's as a chairman had more time in his hands, could actually help a business we think well off, but it's at a similar stage that Zopa was at probably a couple of years ago.
Right.
And I think Giles has great experience in driving scale, and also more importantly, actually, I talked about culture and how Zopa has a great customer-centric culture. And I think Giles has been the driving force of that culture, and that I believe Market Invoice found that very attractive, and I think Giles could help them also have a similar culture. And I think that is the motivation from their side. From us, it was more that okay, there is no overlap, thus there is no possibility of conflict,
right?
And thus he could do that.
Okay. Well, on that note, we'll finish it off. But I really appreciate you coming on the podcast today, Jaidev.
Thank you.
Okay. I just want to go back to something that Jaidev said there, and he compared Zopa and SoFi certainly have low risk borrowers, very high credit type borrowers on their platform, and for them so it makes sense for them to become to offer banking services because that's going to allow them to have a low cost of capital and other advantages that Jaidev talked about. But I also think, and this is something that we've been talking here about Lend Academy for some time, that sort of there's going to be a blurring the lines between an online platform and a traditional bank, particularly when you have the open banking initiative that's happening here in Europe, where you're going to basically have access to your financial data, and you don't need to rely on your bank's app to see your complete financial picture. You can do it through any third party, and I feel like we've had that to some extent in the US, and I think in Europe it's going to be fascinating to see how that plays out. And whereas I still think you're going to see more platforms get banking licenses. I don't necessarily think Funding Circle will be one of them, as Jaidev mentioned, but I think there will be others as the industry gets larger. I think you're going to find the advantages of having a banking license, offering particularly when it comes to term deposits. I think that's something that's a logical product for an online lending platform, particularly a retail investor platform to offer. So before I sign off, I do want to have a special thank you here to Mike Ballerman of the London Fintech Podcast. The recording today was brought to you courtesy of Mike Ballerman's recording equipment, and I very much appreciate him being willing to lend those to me for a couple of days while I'm here in London. So special thanks to Mike. The London Fintech Podcast, if you haven't listened to it, if you're interested in the fintech scene in London, it really is a must listen, and very much appreciate his accommodating my request here. So anyway, on that note, I will sign off. Thank you very much for listening, and I'll catch you next time. Bye.